So Jared. You present for Mr. Dave's class.
No, I'm going tomorrow.
Oh, you're going tomorrow. Are you going tomorrow? Are you presenting?
I'm presenting.
That's
I have
us.
to.
Yeah. I know. I feel like she was like super laid back.
Wait, I missed the day where she was like freaking out.
Yeah, the second day it was
Wait,
just
what
like
happened?
it was like not I think kind of.
He was like crashing on everybody for taking too long.
He was like time constrained. Like
I've never seen her like get mad at people.
we had like 8 minutes left.
It's kind of hard.
She actually got like.
Well, not like that.
But she like interrupt the presentation. She'd be like, no, we gotta move on. We gotta move on. And I'd be like,
I
sucks for them. Not my problem.
I thought it was fair. Because like we had like 8 minutes left and we were like just about to start the point presentation.
Yeah, people are like.
At least she could have just been like, oh, you guys stay late.
That's not fair to the third group.
I mean,
That's
the
true.
assignment does say like 20 minutes.
Yeah, exactly.
Yeah, that's true.
Because the problem was she was like telling people like.
Yeah.
Yeah, she'd be like, stop reading off the iPad. I'm like, just read off the laptop. And then she got mad. I was like, joking.
Oh, you said that?
Yeah, well, I said as a joke. I was like, oh, just read off the laptop. And then she like kind of laughed. It was like kind of mad. I was joking
You have
about
to
it.
play risky to win.
And Joe opened.
Okay, everyone, good morning. Our last class, I've only had one response to this, so that's fine. But I just expect all A's, all right? But we'll have a few minutes after class, or before class is over, to go through some topics if you want to review some things. We can spend our time doing that. You get to vote. Okay, so we're going to pick up got it. Okay, we're going to finish with Pillar 1 on our substantive discussions. And then I got a little wrap up, and then we'll go through some stuff you want to talk about. Okay, give me 1 second, sorry.
What?
Which one?
Oh, for the poll.
Okay, so Pillar 1. So remember, Pillar 1 has, the reason it's not sequential is it's fallen behind in implementation. So that's why we're covering it after Pillar 2. Pillar 2 is right now multinational we're dealing with. Pillar 1, I want you to be introduced to it just because I think it's on deck, if you like baseball analogies. So, okay, Pillar 1 focuses on the allocation of taxing rights. Seeking to reform international tax rules to ensure that multinationals pay taxes in the countries where they have significant economic activities, even if they do not have a physical presence in the country. So, softening up the historical PE thresholds, right, which is more physical. Fixed place of business, bricks and mortar, physical, people, boots on the ground, right? So this is trying to do more, lower that threshold so that countries can attract more taxation rights in their particular jurisdiction. It aims to distribute taxing rights based on where multinationals' customers are located, particularly targeting large digital businesses. So when this was first proposed, the U.S. took this as a direct attack on the United States businesses because those are where those companies typically reside, right? The big tech companies are typically US-based companies, and we're trying to target them and pull some profits from them to be taxed in these market locations. So this may involve new rules for allocating profits based on user engagement or marketing activities in the jurisdiction. So again, metrics that are different than physical presence. People are fixed place of business. It could potentially reduce the need for new, uncoordinated, ad hoc digital services taxes in market countries to address the perceived problem of less than desirable tax being collected from multinationals in those market countries. So, France was at the forefront, the UK was at the forefront, Italy was at the forefront of enacting digital services taxes, DSTs. They may go by different names, but effectively what they're doing is just one country enacting laws trying to forcibly pull another taxpayer into their taxing jurisdiction. And it was based on this digital access. It's trying to access our customer base without meeting the historical standards to become taxable. So the trade-off that the OECD is trying to say is, let's come up with some standard rules to whereby we provide some taxing rights to market jurisdictions that historically did not have them. In exchange for that, you business, we will give up the digital service taxes, which are kind of, just think of them as popping up all around the world, right? Kind of no coordination, no syncing with any of the other rules. This is trying to preclude that, and this is appealing for those digital companies. Pillar 1 applies to companies with subsidiaries in multiple jurisdictions. So again, if you're in a single jurisdiction, you don't have this issue. So we're looking for cross-border companies, and it focuses on the computation and allocation of two amounts, what is known as Amount A and Amount B. And they're going after two different things. Okay? So we'll take those sequentially. So Amount A is applicable to multinationals with group consolidated revenues greater than 20 billion euros and a profit margin of 10% or greater. So if you think back to where we were on Pillar 2, that was 750 billion euros of revenue. So much larger target audience than this one. So this is much lower, and we're looking at profit margins of 10% or greater. Again, they're looking for companies that are generating high profits, high-tech companies. The revenue threshold may be reduced to 10 billion euros 7 years after the entry into force. So again, they're trying to collect this and make this the norm by lowering the threshold sometime in the future once everyone gets used to how these rules work. There are exceptions, extractive businesses, so in the natural resources, so coal, oil, those types of companies, and regulated financial institutions, and some businesses involved in the defense and intelligence services are excluded. So they're looking for real commercial market-facing companies, and you need to be a multinational, so you have to have operations in multiple countries. Smaller businesses, entities outside of the multinational category, and those not highly digitized or customer-facing are generally not affected by Pillar 1 Amount A. Okay. Practical application of this, it's designed to affect those businesses operating in sectors such as digital services, e-commerce, other industries where value is increasingly derived from user participation, data, and intangible assets. Think of search engines, social media platforms, and online marketplaces. Who do those sound like? Sounds like Silicon Valley, right? That's your Amazons, your Meta, your Googles of the world. So some very powerful, deep-pocketed companies that are extracting revenue from around the globe and not paying tax in all those jurisdictions under historical standards. It's also designed to affect those companies that generate significant profits from activities in countries where they may not have that physical presence, but nonetheless have a large customer base. Think of consumer goods, automotive, and pharmaceutical companies. Again, so not all just high tech. High tech is, I think, a large attraction for these market-based companies, market-based jurisdictions, because of the profit levels of these kind of companies are just mind-boggling. But also, consumer products companies, automotive and pharmaceutical companies are also in the crosshairs here, again, because those can be drop shipped into the country without a physical presence in those countries. It is widely expected that global implementation of Pillar 1 will be a net cost to the U.S. Treasury. Okay? You guys know anything about the budget situation in the United States? We run deficits on a current year basis. Each year's deficit gets added to the debt that we have in the United States. We spend more than we take in. You're spending more than you take in, you're not interested so much in taking in less, right? That's working against anybody who's trying to get into a balanced budget or eventually pay down some of the debt. So I think that's one of the reasons this thing has not gotten the traction that you would otherwise think it could have. It might sound good aspirationally, but the practical implications for the companies that are involved are very powerful, deep-pocketed and lobbied, and the major treasury that's going to be affected negatively by this is the United States. Okay. So Amount A, just the framework of Amount A, just so you get a sense of what's happening here. It's a new multi-step formula, non-arm's length. Remember we were talking about transfer pricing? The general principle is we want to price related party transactions in an arm's length manner. Like, how would you price that transaction with someone who was not related to you? That's the standard. That's the gold standard we're trying to get to. Okay? This is trying to get away from that. And now we're not talking about just related party transactions. We're talking about how much profit do we put in these market jurisdictions. Right? So it's got a transfer pricing element on it, but we're not talking necessarily about transactions between related parties. Okay? So we're thinking the parties that be on this are allocation of 25% of deemed global residual profit. So what's left after something. Pre-tax profit exceeding 10%. Okay? So give 10% the way it was going before. Anything in excess of that 10%, 25% of that would go to countries where customers are located, in the parlance of this proposal, market jurisdictions. Okay? Regardless of where the company's physical assets and activities are. So we're going to take a slice of that kind of outsized profit, anything above 10%, haircut that by 25%, and take that and spread that amongst the market jurisdictions. Okay? If you're talking about a U.S. high-tech company, all of this was going to the United States. This profit was being allocated into the United States. So we're talking about the U.S. has to be willing to give up something for this to work. Amount A is intended to be implemented primarily through what is called a multilateral convention. Those are very similar to the tax treaties. It's like a model treaty. Every one of the tax treaties that would be involved would have to be renegotiated and implement Pillar 1 computations. Now, they're trying to do this through a multilateral convention. Multilateral means all the countries sign up to it. Automatically gets baked into the existing treaties. Because they're trying to make implementation easier. Because if you had to go and change every treaty we've talked about, that's a multi-year process. Right? That takes a long time for that to happen. And some countries don't talk real well to others, and so it may take even longer. So they're trying to put some overarching agreement in place that would automatically implement this once agreed. Okay, but this structure has a highly complex architecture with extensive technical guidance and comprises multiple parts, roughly 50 plus articles and several annexes, so appendices to the treaties. So nothing about this is easy. You're trying to do this over all business, and every business is different, right? So you're trying to write a rule. Just think about the complexity of trying to do that. And all the different constituents, all the different countries, it's just incredibly complicated. So I think the reason this has fallen behind in getting any momentum towards implementation is that point I made about this primarily affecting negatively the US Treasury. You have the largest economy in the world is kind of lukewarm at best, something like this. And secondly, just the administration of this. Companies are throwing their arms up like, it sounds great in theory, but this is incredibly complicated. How are we going to do this? And then the implementation and just the guidance on this is just mind-boggling. So the implementation will require coordination to eliminate double taxation. If incremental group profit, so that 25% of profits above a 10% return is allocated to market jurisdictions, then the affected jurisdictions must accept reduced profits via a larger foreign tax credit. That's where the rubber would hit the road for the United States and how we collect less profit. If we see taxing jurisdiction to more jurisdictions, more host countries, if you will, then we have to give up more foreign tax credits, which means we collect less tax. Paying your U.S. tax with credits that you pay to other countries. Or for other countries that might be affected, like the U.S., they have less profit within their taxing jurisdiction because they may be territorial or exemption countries, right? They're going to cede some of that profit to be outside their country, which they don't tax in a territorial regime. So Amount A is expected to result in higher allocation of group profit to market jurisdictions and pull it away from the historical jurisdictions that had it before. I'm not aware of any country in the world that thinks they have excess cash in their treasuries. So this one's got a little bit of work to do. There are espoused benefits for the business community. Okay? It introduces new dispute prevention and resolution mechanisms. There's review and determination panels that are set up. Again, complicated. How is this going to work in practice is the questions that business has. But you already have countries that are trying to grab more profits in this instance. In these instances. And so it's already happening. They're not waiting for these rules to come online. So companies are trying to guard against that. And this is trying to say, okay, we're going to have to provide new dispute prevention and resolution mechanism. And again, as we talked about before, it takes away these DST regimes that as part of adopting these rules, you have to give up what you might have otherwise been doing on a unilateral basis. And that's good for business as well. Question is how soon will those countries give up those regimes when they think that this is functioning the way it's supposed to be functioning? Right now we have these random DST regimes. Okay, so that's amount A. That's about pulling profit that has historically been taxed in one location and pushing it to these market jurisdictions to compensate them again for what I think we would all think is reasonable. Accessing their customer base without paying anything in those countries to support the ability of those customers to have the wherewithal to do these transactions. Okay? Amount B is different. Okay? Amount B applies more broadly with no specific income thresholds required and is applicable to companies engaged in routine marketing and distribution. So remember when we talked about one of the transfer pricing methods was cost plus? Cost plus is typically used when you're dealing with routine service providers. So routine manufacturers, routine distributors, you give them a routine return, right? Everything else goes back to the part of the organization that has the risk and responsibilities of running the business. But routine manufacturers and distributors can get a routine return. So this is trying to set some conformity around the world as to what is that routine marketing and routine distribution. So again, it only applies to multinationals. Okay? But this is not for just big companies, it's for any size companies. We're trying to put some standardization around the routine returns. So traditionally, the arm's length principle has required multinationals to determine transfer prices for intercompany transactions based on what unrelated parties would do. Amount B seeks to streamline and simplify that process for routine marketing and distribution activities. What it does is it defines a fixed, simplified methodology for determining arm's length compensation for marketing and distribution with predefined margins and returns. Okay? If you do these types of activities, you get this. There is no need to go out and search for cost plus, do comparables and things such as that. And think of the countries that this might be affected. Mexico, large manufacturing base, right? Lots of times they're doing manufacturing on behalf of US headquartered companies, but they're doing what the instructions are from the home office, right, from the headquarters. Make this car in this fashion by the state. Not a lot of entrepreneurship going on there. You're just doing what you're told, right? And doing the manufacturing. This would tell Mexico what that operation is entitled to return, what return that operation is entitled to. Okay? Predefined returns. It reduces complexity for low capacity countries, allowing tax authorities to apply a more straightforward and transparent method for these activities. So those countries that do not have a large tax enforcement function and are resource constrained and to audit these activities, they just know what they're supposed to get. That's cost plus 10, cost plus 15, whatever the countries decide at the end of the day, but it's predefined and you get that return. It's very simple from an enforcement standpoint. Right? And it ensures consistency across jurisdictions so that multinationals do not face inconsistent transfer pricing rules and audits. So if you're doing what amount B says, you should be fine from an audit perspective, both in the home country, because they're ceding the taxing rights for that amount of the profit, and from the host country, they're getting collection for that amount of profits, right? So taking away some of the defense portion I mentioned of transfer pricing studies and doing all the work to support your transfer pricing and fall back to these predetermined levels. So, status of implementation. Pillar 1 is in a negotiated but not yet implemented state. It's not imminent. Okay? Part of this, I think, is the OECD and the countries are pushing forward with Pillar 2, trying to get that in place, right? Whenever you're implementing things, sometimes that's more art than science. Get something done, get some momentum, then tackle something that's harder. So Pillar 1 is just on the back burner right now. While detailed designs have not been designed, particularly for Amount A, final agreement and widespread ratification has not been achieved. There's just not agreement amongst the parties, the countries. And I know that's surprising. We have trouble getting agreements between 1 or 2 countries. Can you imagine trying to do this for 130 countries? It's not easy. Everybody's got a perspective on this, and there's vested interests on both sides. So, as a result, the implementation of Pillar 1 is still pending and subject to ongoing political and jurisdictional negotiations. So, I do think something like this will ultimately happen because this is a problem of the historical standards for measuring when you become subject to tax are rather not applicable to the current, to the modern economy, right? This physical presence is not kind of out of place with the whole segment of our economy now. And what that's done is it's caused market jurisdictions to not collect the right amount of tax that they need. So I do think something's going to get here. The devil's in the details of getting this done. Okay. Challenges faced by multinational groups. It's complicated, uncertain implementation discussions across multiple countries. So again, some countries who feel they are being shortchanged in the collection of revenue are doing stuff on their own. They're like, I'm not waiting. I don't have to wait. I'm a sovereign country. I can make my own laws. I do not have to wait on the OECD. That's these digital service type taxes that are out there. That's caused chaos for companies. How do I comply with that? Can I get a foreign tax credit in the United States if I pay a digital service tax? The United States, it says, no, that's not an income tax. So am I paying double tax on that revenue now? So it's caused a lot of concern on the business front. New costs for data collection and compliance. Being subject to tax in another country is easier said than done. You need advisors, you need to file tax returns. How do you do that? What if you just doubled your tax filings? Double your tax department? Double your accounting firm fees? They'll probably tell you yes. But just compliance with this is going to be a huge headache for multinationals. The complexity of multi-step calculations and safe harbors. So all that administrative guidance I mentioned is trying to deal with different types of taxpayers. So explaining why you're in this particular bucket of taxpayers and the multi-step process that you have to go through is going to be hard for companies to comply with. Adjusting to potential new taxing jurisdictions. That's what I was mentioning before. Just becoming a taxpayer in another country has an element of administration that is difficult to do. Finding advisors. Are they English speaking if you're a US-based multinational company? How difficult is it to get work done in that particular country? The promised carrot of dispute resolution and tax certainty. I think there's a element of I don't want to say distrust, but uneasiness with the proposition that, oh, you're going to give me back uncertainty if I go forward and submit myself to being subject to tax under Pillar 1 provisions. So is that real? Does business feel like that's a real trade-off back here? Okay, so that's a little bit about Pillar 2 and Pillar 1. Those are cutting-edge things that are happening globally, irrespective of what the U.S. wants to do relative to those provisions. The rest of the world is moving, especially on Pillar 2. Pillar 2, those laws are being enacted in other countries. So 2025 and Q1 of 2026 is big financial statement quarters for multinationals and trying to be compliant with those provisions. Okay, so that's it for our subject matter. I do have a wrap-up slide I want to go through. Yes. Okay, so I told you before, the subject matter for the final is just half B. It's not anything on half A, but we're here to learn, and you guys have been all the way through everything that I think you need to know from an international tax perspective. Okay, I did this stuff for 25 years. So remember what we did in half A. We did a bunch on outbound taxation. We did the foreign tax credit, and then we covered anti-deferral regimes, right? Subpart F, GILTI, a new regime, similar to GILTI but slightly different, net CFC tested income, and then the 100% dividends received deduction. And then for inbound taxation, we talked about inbound companies doing business in the United States, becoming subject to the United States. We had some topics that were common for both. The taxing jurisdiction, who gets to tax what? Those issues are prevalent in outbound for U.S. outbound investment, inbound investment from abroad, and then the sourcing of income and deductions. What we've done in half B is add on to that. There were some gaps that we couldn't cover in half only course. So we did planning for foreign operations, thinking about how do I affirmatively go into these other countries knowing I'm going to be subject to tax, but managing my foreign tax credit, managing when I become subject to tax. On the inbound side, we did withholding from U.S. source income, so outbound payments, we covered all. So you're either doing business in the United States or you're deriving passive income flows from the United States, and then also planning on how you would properly come into the U.S. for your business and when you become subject to tax. We added some important topics that are common to both. Foreign currency, you're doing cross-border transactions, you got to be priced in one currency or another, right? You gotta pick a currency, that means one party on the other side of the transaction is offsides on the currency. That can either be a translation issue, if it's your business and you need to roll it up into your financial statements, pick a currency. Or it can be a transaction itself, so you're not rolling up the business, you're doing a transaction with a third party, but it's not in your functional currency. So how do you tax affect the economics of winning or losing on that currency selection on the transaction? Export benefits. So export benefits are the FDII regime and the FDDEI regime. And those are really powerful benefits and for the U.S. and for exporters of services and exporters of products and exporters of services. Transfer pricing. Transfer pricing is everywhere. Everywhere around the world. What's the pricing between the transactions for related parties? Prevalent in the United States. Because we have the same jurisdictional elements between states. Right? You're doing one organization doing a transaction with another related party across state lines, that's the same issue. And then tax treaties who are trying to deal with the contractual relationships to ease all these burdens on cross-border transactions. But I know it can kind of seem like what we went through in both halves of these courses as things being kind of subject matter specific, but they do have a framework amongst them. And I think if you just step back from it occasionally and look at from a whole, you can get your arms around what's going on in these things. And what's good about this is once you start understanding the way these regimes work, the next proposal that comes up, you can say, oh, okay, that's kind of like this. I see why that's doing it. Or I see why the UK is doing this. Well, that's kind of like the German rule, or that's kind of like the US rule. These countries take each other's ideas and use them. And they tweak them to the way that they want them to be, but people are pulling ideas off the shelf all the time on this type of thing. So this gives you a flavor. You guys have went through, I don't have any more topics that I think you guys would need to know would be very dangerous on the international tax front. So this is a great area of tax law. It's a great area of business because it's super complicated and it's ever changing and it's hard for companies to get their arms around. So the people that can function in these areas are pretty well taken care of within those organizations. Okay, let's see what you guys want to talk about. Is everybody kind of voted? Do you guys want to talk about inbound tax planning cases? Is that what we want to go with? Okay, let's start there. That is, I think, chapter 11, if you want to pull up your slides. I'll just kind of run through what I think is most important that I would take away from this. Okay, so I'll just start rolling through the cases here. Okay, so case one was no dividend paid from the United States. So here, you're just going to get to the 21% effective tax rate, right? Withholding is not applicable. We don't have a distribution. There's no double taxation of the corporate earnings. This might be you're in growth mode in the United States and you're just going to roll every after-tax dollar back into the business. So you don't have to worry about withholding tax and you don't have to worry about the foreign tax on the receipt of the dividend. Might not be a big issue because most countries are exempt, are territorial, so they can tax that income. Okay, the second one is dividend paid, but a tax treaty. So the only implications here that are different from the first one, we still have the US tax, right? Because that's not dependent on your dividend policy. It's not dependent on how much dividend you pay. You're going to pay 21% of your US profits. But here I repatriate 50% of my profits in the form of a dividend. That attracts a 10% withholding tax, so I get $395,000 here. I do not have any foreign country tax on the dividend because, again, the premise here is I'm a territorial on the inbound side, so no tax there. But my effective tax rate went north of 21 because I'm attracting that $395,000 of withholding tax. That's a true cost to this inbound investor because they can't credit it. They don't have any tax on the dividend income, so there's nothing for the foreign country to credit it against. This is a real cost. Case 3 was a dividend paid, very bad facts, no tax treatment. Okay, here, so our effective tax rate goes way up, and that's because the same 50% repatriated is times 30% U.S. domestic withholding tax because there's no treaty applicability here, so my effective tax rate goes way up. Here I have a low tax parent, no dividend, but I'm repatriating profits from the United States in the form of a higher transfer price. Okay, so I'm going to pay more for inventory items, so there's going to be a higher cost of goods sold in the United States. And payments for materials and services are not subject to the U.S. withholding tax, but country F tax rate is 15. So I got 15 at the parent, 21 at the U.S. subsidiary level. So effectively what I'm doing here, the takeaway is by virtue of an additional cost of goods sold for the U.S., so the U.S. is paying for inventory that it buys from the parent. So that is pulling profit from the United States and putting it in the parent, right? Think of it as within the arm's length range of transfer pricing, I went to the higher end of what I could pay for the inventory. So I effectively have moved $3.95 million from the United States to the foreign parent. So my U.S. tax liability goes down because my base went down, but my base went up by the corresponding amount in the foreign jurisdiction. Foreign jurisdiction is not going to do territorial on that because they sold inventory. That's taxable in any country, right? But it's 15%. So here, moving profit of 3.95 from a 21% jurisdiction to a 15 means I get a 6% benefit on each dollar of profit that I move. And what that's going to do is move my effective tax rate below the 21, put it in green here, down to 18.63 because I'm pulling group-wide profit out of the United States and placing it in the foreign parent, which is lower taxed. Okay? And this is also leading to less pressure to repatriate a dividend. Because I'm getting money out of the United States, but as in the form of a deduction. Remember, dividends are not deductible. You're deriving taxable income. Okay. Case 5 is now I have a high tax parent, and I do the same higher transfer price. So facts are exactly the same as case 4 on the 3.95, but I'm moving that from the U.S. 21% tax rate to a 30% tax rate. I have a negative 9% tax arbitrage on that transaction, and that's driving my effective tax rate north of the 21% because I'm pulling profits out of the United States at 21% and taxing it at 30%. So this might be called for under transfer pricing, but you just know that it's working against you because you got a high tax foreign parent. Case 6 is low tax parent, and I repatriate with interest and royalties. Again, factually, I have to have the opportunity to do that. I only can pay interest if somebody's lent me money. I can only pay a royalty if somebody's licensed intellectual property too. So those factually have to be present and just start making those payments, right? So here, I'm making payments from the United States to the foreign jurisdiction on that, and it's 1.95 for royalties and $2 million of interest. So that's at 3.95, same number. Prior 2 examples. Country F has a 15% tax rate and 0% rate of withholding on interest and royalties. So here, similarly, I'm moving, this is the same result as case 4. I'm moving 3.95 from the United States at 21%. And I'm putting it down below in the foreign jurisdictions tax return at 15%, so I'm getting a benefit of 6% on the tax arbitrage, which gives me that same 18.63%. Now, why am I doing it here? Well, factually, I might have the ability, might be required to pay interest, might be required to pay a royalty. I might not have ability to adjust the transfer price in case 4. And it could be a blend of some of case 4 and some of case 6, right, depending on my facts. But that's it. This is going in the right direction from a pure tax perspective. Pulling income out of relatively higher and taking it to a relatively lower. And 7 is the analog to case 5, that I'm paying base eroding with interest and royalties. I'm taking that 3.95% and moving it to a 30% jurisdiction. So now I got a negative arbitrage of 9% by moving that profit via interest and royalties from the United States to the foreign parent. That gets me back up north of the 21% of that tax. Okay? So I think when you're looking at the cases, just try to compare and contrast them. Think of them as levers that are moving. Like, what's moving my effective tax rate? How tax rates of jurisdictions in which I'm doing business, tax rates to where profits are going, treaty applicability, and withholding tax rates, and base erosion. Am I moving taxable income amongst jurisdictions? That's what's all going to drive your effective tax rate. And again, I want you to think about this in terms of how is the tax person talking to the CFO, or how is the CFO talking to the analyst community, explaining what their effective tax rate is. Oh, well, we pay interest from the United States at 21, and our foreign parent is picking it up at 30%. Everybody's going to understand that once explained, but getting in granular as to what's behind the numbers. Okay. Okay, Pillar 2. I'll do Pillar 2 real quick. So the things I want you to take out of Pillar 2 . The hottest thing going on in Pillar 2 is the side-by-side agreement that was just agreed upon between Treasury Secretary Bessent and the G7. Side-by-side agreement is remember, Pillar 2 is the minimum tax initiative from the OECD. We want to raise the rate of tax that you pay in every country. Pillar 1, we talked about today, is trying to move income to those countries. This is saying, what rate of tax do you pay in those countries? We want you to pay 15% everywhere in the world in which you do business. At least 15%, right? Very complicated, kind of cross-reliant collection mechanisms. Qualified domestic minimum top-up tax, then the income inclusion rule at the parent, and then the under-tax payment rule if you don't apply them. And they're layered, right? So it's kind of the design of it is, all you need is one country in the world to enact the under-tax payment rule, and then they get to collect all of the top-up tax in the world. Once everybody sees that, then they start adopting their rules. So it's very clever, I think, in the way they designed it. But the hottest thing going on in Pillar 2 to protect U.S. multinationals is the side-by-side agreement, which for the IIR, the income inclusion rule, which is the parent adopting the minimum tax rules, the idea is that the U.S. system, guilty for 25 and earlier, net CFC tested income, 26 and forward, is sufficient enough to accomplish the minimum tax objectives of Pillar 2, meaning they can live side by side. Right? The inherent limitation, the U.S. cannot change the rule right now. They're not going to do another tax bill to make the NCTI regime exactly like the Pillar 2 rule. Not going to happen. But it's pretty close enough. Right? The 15% minimum tax, the devil's in the details, as the computations are a little different, but it's pretty darn close. And so that's the idea, is that it can live side by that. Now, the other element of the side by side is that the US domestic system is at 21, so you'd automatically think, well, it's north of 15. But remember, the base on which Pillar 2 is applied starts with financial statement income. Makes a few adjustments and then applies 15% to that. We know there are some companies in the United States that have high financial statement income with lower taxable income. Okay? And that can be driven by outsized deductions that are applied for tax purposes that don't apply for book purposes. Okay? Principally, that's accelerated depreciation, which exists for tax, doesn't exist for book, and stock option expense exercises that are deductible and can be larger for tax purposes than for book purposes. Those can drive companies down to where they fall below that 15%. We have a U.S. corporate A&T regime, alternative minimum tax regime, that came in line with the Biden administration. Again, it doesn't work exactly like Pillar 2, but the U.S. was persuasive in saying it's close enough. Do side by side. So don't be, when the U.S. is down below in the structure, not the parent group, don't be trying to apply all these Pillar 2 rules to the United States. Because we have effectively a qualified minimum domestic top-up tax. It's corporate alternative minimum tax. Okay? Again, we're not going to change our legislation to match yours, but it's close enough. So those are the biggest things in Pillar 2. And the other thing I would mention here is this timing problem. The G7 agreement is an agreement. Think of it as a handshake agreement in a room with the Treasury Secretary and the G7 representatives that we agree we're going to run side by side, Pillar 2 and the U.S. rules. But what are the accounting rules applied? Enacted law. We don't look to handshake agreements, right? So the G7 agreement hasn't been affected into the country's laws. So I would love to be a part, and I don't do this anymore, I would love to be a fly on the wall and listen to these discussions, because I can guarantee you companies are saying, G7 agreement, I'm good. I'm a U.S. company, and auditors are saying, no, that's not what the law says. I don't know what the law is going to be whenever all these countries enact their laws. It may not say exactly what the G7 agreement says. So you still need to do some of the computations to be compliant with these rules. And those other countries might be looking for filings, the information return filings that have to happen, and auditing those transactions. So I think there's some near-term turbulence in getting to where we're going to be that U.S. multinationals are facing right now. If you go to work for one of these large companies, you're going to hear them talking about Pillar 2 a lot, how they're going to try to be compliant, how they're going to try to keep their financial statement auditor at bay, and yet be compliant in the countries doing the bare minimum, I would say, that they need to do because they don't want to go too crazy. Okay, limitation on benefits. That's what I thought was the most complicated, one of the more complicated topics that we talked about. That is chapter 13. Okay. Limitation on benefits, right, is trying to police who can get access to the treaty. We negotiated a contract, the treaty, and signed it with that country, and it's intended for the tax residents of their country and the tax residents of my country. It's not intended for a third country to swoop in there and try to get access to that agreement. The US has been at the forefront of putting forth these LOB provisions, limitation on benefits. They're also anti-treaty shopping because that third party is treaty shopping. Like, hey, that one looks cool. Can I just get that treaty and apply that in my structure without being a tax resident necessarily? So that policing of the front door of getting into tax treaties is the purpose of LOB provisions. And it's always the third country that's involved. If I have a bad result between these two countries, and I try to interpose a jurisdiction to make the collective results between these two countries better, either lower withholding tax or capital gains exemption or something else in the treaty that I'm trying to get, that's when it's going to stick out like a sore thumb. That doesn't mean I can't do it. It's just I have to go through the LOB provisions and make sure I meet one of those. And remember, the United States is adopted the LOB provisions in their model treaty on a very objective basis because they didn't want to have debates about the subjective nature of why did you put this entity here. The U.S. tried to set up objective measures as to when it's appropriate for that country to be respected and when it's inappropriate for that company to be respected. Okay? So LOB provisions, if you fail to meet those, will effectively disregard that intermediate. And it was never there. You're back over here. You didn't accomplish what you thought you accomplished if you didn't meet the LOB provision. Okay? And there's lots of, these are the tests. And I think each one of the tests makes sense because there's an element of business rationale why that interposed entity is in the chain apart from treaty benefits. Either there's some business rationale, there's a publicly traded aspect to the structures, there's either an element where I already had a good position between the two countries, so interposing a third country can't be tax motivated if I already had a good result, right? And so they'll look through that and say, oh, did you already have a good result? That's the derivative benefits provisions, those types of things. And they all have a base erosion element because they don't want you to say, just look through and say, oh, you had a good result. Because if this company is making payments out to someone who is not entitled to treaty benefits, your ownership structure looks good, but the flow of cash goes to the wrong person, right? Because of the inappropriate payment of deductible expenses in the middle of the chain. So that's what these, the derivative benefits in this both stock ownership and base erosion test 3 and 5 do. And then the active trader business, that's the one where, yes, there's something really going on in that country and it relates to the other treaty partner. So again, some element of business rationale as to why that entity is in that structure. And there's examples for all of that. And remember this case, the Tiger Global case, kind of really a big deal, just recently happened and kind of shocked the investment community because there was very little going on in Mauritius here, and it was an outsized result the taxpayer was trying to get by exiting the sale of this Indian company and not paying Indian capital gains tax that was otherwise due. Mauritius was a tax resident of Mauritius. The treaty between Mauritius and India says India gives up its right to tax capital gains. So India is one of those jurisdictions that taxes non-resident shareholders on their capital gains. So again, this was a sale. The buyer was Walmart. This was a large investment. I think it involved India and Singapore. I gave you simplified facts here. But sold 2 large subsidiaries, and there was a major U.S. investor here that was investing this. You have a lot of investment from the U.S. going into India via Mauritius. And so those people are all looking like, ooh, that doesn't work anymore. So what am I going to do with that? Okay. All right. Exceptions to U.S. withholding tax. Okay, this is chapter 9. exceptions to US withholding tax. So remember, we have US withholding tax on US source payments, so payments from the United States abroad, on what is called FDAP income. That's the acronym for fixed, indeterminate, or annual or periodic. But think of it as your passive income flows that happen more than once. Right? Dividends, interest, rents, royalties, those types of things are what we're talking about. So here we have exceptions to US withholding tax. And the way the rules are written, right, there is withholding tax. It is based on domestic law at 30% unless reduced by treaty. And then there's exceptions to it, which are finite. Right? So those exceptions are if it's connected with the US business act income. So that means, oh, if the income is going to be taxed in the United States anyway under a business tax return in the United States, a corporate tax return, then don't withhold on me because I'm going to include the income in my US tax-based income. Makes sense. I think the example is this one. So we have a foreign company who has a US branch. They deposit money with a US bank, and the US bank pays the interest. So remember, a branch is no different than the foreign parent. So bank feels like they're paying foreign company. Start off with, oh, withholding is due because it's a US source payment from a US deposit, and I'm going to withhold at 30% unless you prove to me a treaty is applicable. This is when foreign company says, no, this relates to my US branch activity. I will include that interest income on my US tax return, my 1120F that I file in the United States. No need for you to withhold. So they provide documentation to that effect. US bank, and the US bank would use that as their defense to, why didn't you withhold it? Why do you think there's an exception here? They would say, here it is, because this person told me that they were going to file US tax return. Gain on the sale of US personal property. Remember, this one I don't use so much as an exception in this way I consider it. It's not so much an exception, it's just, it should never be subject to withholding tax. So if we have a foreign parent selling personal property, that the general rule is seller's residence, right? A sourcing rule. The seller is foreign, that's a foreign source gain. We don't withhold on that. We don't even tax that. It's not in the US taxing jurisdiction to begin with. The biggest example of that I think we have is a sale of shares. So personal property includes the sale of stock, right? Stock is personal property because in this instance, we're not talking about personal property or capital gain property. Personal property is just everything that's not real property. Okay? Not real estate, not land, or something permanently fixed to that. So a big example of that is stock in a US company. If I have a foreign seller of US stock, we source that gain to the seller's residence, which is foreign. There is no US withholding on foreign source gains. Okay? It doesn't matter if they sell it for $1 billion gain, not subject to US tax. Okay? That's actually embedded in the treaties as well. Okay? The portfolio interest exception. The portfolio interest exception is, this is intended to incentivize foreign persons entering into the US and holding bonds of US borrowers. So it allows foreign shareholders owning, the portfolio interest exception applies to bonds, notes, or other debt instruments issued by US borrowers, which can be corporations, partnerships, or government entities to certain foreign persons. Importantly, it does not apply, so the exception to the exception of withholding is if it's foreign banks. And that was just pure lobbying by the US banking industry that they didn't want to keep foreign banks. So basically what this is for Ray Allen here, a individual non-US taxpayer who holds a bond of a US company and gets interest from that bond issuer, and that's not going to be subject to withholding tax on the portfolio. Here. US bank deposit interest exception, so this is again lobbying from our banking industry. If we have bank deposits from a foreign creditor, so if a foreign individual has a U.S. bank account, savings account, and puts money in that, they are a lender. The U.S. banking institution is the borrower. They have to pay, compensate that lender with interest. We don't subject that to withholding tax. Why? We want to make the U.S. banking industry open for foreign investment. So what we just talked about is the U.S. using it as a protectionist element where foreign banks can't hold bonds, but we want the U.S. to hold banking deposits. So there's a U.S. bank deposit interest exception. And then treaty tax reductions, we know that on all types of FDAP income, we have to go into the exact treaty between the two countries, and we can many times get a lower withholding tax rate than the 30%. Okay. Okay, foreign current, let's finish up with the foreign currency stuff, because I think that's also kind of complicated. And that stuff is in chapter 6. Okay, so translation. Translation is simply that I, as an owner, as a U.S. taxpayer, if I'm investing abroad, so in an outbound context, everything has to get reported in U.S. dollars. You cannot file a U.S. tax return in anything other than U.S. dollars. You can't report euros, you can't report RMB, anything. It's all got to be in U.S. dollars. So there's a translation element. I have to take the results of what I've done abroad that may be denominated in another currency and translate it into U.S. dollars. Okay? So examples of translation issues could be the income or loss of my foreign branch. If I have a U.S. owner of a foreign branch, I'm likely doing transactions in that foreign branch's functional currency, right? The economic environment in which it's doing business. If those are euros, they're currently taxed in the United States, but not as euros. They got to be translated into U.S. dollars. So remittances from that foreign branch back to the U.S. parent. So branch setting, it's not just the translation of your activities, but what if I make a distribution of those profits back to the United States? I am then translating what was included in taxable income at one exchange rate, and I'm going to tax effect the win or loss on the economics of the physical transfer of the profits back to the United States at a different exchange rate. Right? That's the 987 gain or loss computation we'll go through in a moment. And then my anti-deferral regime, subpart F, GILTI, and NCTI are all in foreign currencies, right? Those are foreign jurisdictions, foreign subsidiaries. I'm doing business in other than U.S. dollars. Those activities, if I run afoul of subpart F, which remember is transaction by transaction, GILTI is a broader concept, NCTI is yet even broader. Those items are all in non-U.S. dollars. I have to convert those into U.S. dollars to put those items into the U.S. tax return because I'm not subject to deferral of the taxation of those items. Okay, so we'll do branches first. So qualified business unit, that's an important computation or determination. That's when must be a separate and clearly identified unit of a business of a taxpayer that maintains separate books and records, right? So it's not your drop sale one time and done. It's a ongoing operation. Think of everything that is involved in an income statement, income, expenses. Somebody's measuring that. There's a separate trader or separate books and records that somebody's looking at. Those items would give rise to a QBU, meaning that branch is now a QBU, and I'm in these translations. This is just saying what is a QBU. I want to go to the functional currency. So each QBU makes its computation such as computing its taxable income in its functional currency. functional currency of a QBU is the economic environment in which it conducts a significant parts of its business. So you look at all the facts and circumstances in determining that economic environment. What is the country in which, the currency of the country in which it's resident? What currency does it realize cash flows, generate revenues, incur expenses, borrows, and lends? Many times this is very straightforward. It might be a European branch, so everything's in euros. But I have seen many times where you have a QBU that's got things going on in different currencies, right? You might have 4 or 5 different currencies. So you have to make a call. What is its functional currency? Right? You have to land on that, and then you have to translate off of that. So section 987 is talking about the remittances from those QBUs. And so I have foreign currency gain or loss resulting from branch remittances. The remittance is the physical transfer. It's usually cash, but it can be non-cash property. But think of it as the equivalent, we're talking to business entities about dividends. It's effectively the dividend equivalent, but it comes from a branch. You can't call it a dividend, because only corporations pay dividends. Branches make remittances, but it's a after-tax earnings that are distributed to the owner. Okay? So, my 987 gain or loss on slide 15, this, you take your net unrecognized 987 gain or loss. So this is all of the currency movements between when you included the income in your U.S. tax return, at what exchange rate did you do that? And then you multiply that times the amount of the remittance over the adjusted basis of the branch assets. That will get you your 987 gain or loss. So you're essentially pulling a portion out of your unrecognized pool of currency gain or loss. And that portion is measured by the amount of the remittance over the adjusted basis of the branch assets. That will be your 987. That's the simplest, easiest way to do the 987 computation. The government has in the past tried to get more complicated than that. They have recently signaled they're going to come back to something much more simpler than this. My experience has been most companies are doing something much more similar to this because you have to comply with the statute, the regulations that the government has issued to all of those places. That's a great example, 6.5 of that computation. Okay. Foreign currency transaction. So now I'm doing a specific transaction that, as a U.S. taxpayer, I am offsides on the currency of that transaction. I like the easiest one to think about is I sell to a European customer and the receivable is priced in euros. So I have to convert the sales price to dollars because I'm going to include that in taxable income currently, right? But now I got a receivable, an asset on my balance sheet other than U.S. dollar. That's the booking date. That's the date it was created. Then there's going to be a payment date when that receivable gets collected. Those exchange rates are going to be different. So I have a 988 in this instance. It's the code section right after the branch remittances. That tells me what's my tax effect of the gain or loss of that transaction. So that can be 988 transaction could be dealing in non-functional currency itself. So if for some reason I have a U.S. taxpayer and I have euros, or I have RMB or Indian rupees, whatever I have, if I sit on those, I have a basis in those assets. When I dispose of them, I have a gain or loss. Right? That's a 988 gain. It could be a debt instrument. So if I borrow in non-U.S. dollars or I lend in non-U.S. dollars, which includes receivables and payables, then that will also drive an ultimate 988 gain or loss. And I could have financial instruments which really make it complicated if I'm starting to hedge my foreign currency exposure and I'm entering into forwards or futures or option contracts that are denominated in non-functional currencies. I have lots of rules that both from an accounting perspective and a tax perspective which try to match the exposure with the hedge. If I do that, then I can do that as a synthetic instrument and potentially not have an issue. I don't meet the hedging requirements, then I got 2 separate transactions to deal with. And you get whipsawed on that because might have similar amounts, but one might have a different character than the other. So one might be ordinary, one might be capital. Be careful if you're a corporation, because losses on the capital side, if you're a business entity, capital losses are only deductible instead of capital gains. That's a bad place to be. Okay. So the disposition of the non-functional currency is no different than any other time we have talked about in this class or other classes about the computation of a gain or loss. It's your amount realized, what did you get, what was your adjusted basis, what did you have in it, and that's your gain or loss. So if it's a receivable, I'm selling euros, I'm selling product abroad into Europe, and on a receivable that is euros, I take a basis in that equal to the sales price, that conversion at the sales price, that's my adjusted basis. When I collect the euros, they're going to be worth dollars, either more or less than that. That's my amount realized. The difference is my gain or loss. So not an exotic computation of that. If you get a question on this, just make sure you double check which way the exchange rates are swinging. It's easy to get a gain that should have been a loss or a loss that should be a gain. Just make sure you step back from it. It's like, does that make sense? I always think of it, did this taxpayer win or lose on that exchange rate movement? Did they get more of their currency by virtue of the exchange movement? Crypto, I put in here, it's not a foreign currency, but it's not US dollars. So the reason I put it in here is because it functions exactly the same. The United States views crypto, all versions of crypto, all versions of any type of currency that is not US dollars. It is property. And all transactions involving property, you can have a gain or loss between when you acquired the property and when you disposed of the property. Okay, so we'll pause there. Final is on final is Tuesday morning. Okay. If you have any questions as you're thinking through things, just send me a note and we'll hash that. Okay. Thank you.
I need to do that now. That's like what I was doing.
Oh, you.
I haven't scheduled it. I
They
thought
won't
I'd
let you
scheduled it
take
earlier. You know, it's like a week.
Well, and like they don't like you.
Okay. So like, would it be like Thursday of that same week?
Yeah, I like scheduled mine because every time I try to make it, every time I try, like they like send me the back. Like you can't do that, so I just want
Is
to
that
have
for
that
like
this time.
every like exam? Like is
Yeah,
that week?
I don't think DR opens for exams.
So they say you can take on it.
Okay. Like next Thursday, you're saying? Not tomorrow, right?
No, like next Thursday.
Okay.
I might take this.
That would be,
Yeah.
like tomorrow, that would not.
No.
Don't you have a class on it?
I
Because you said you couldn't take.
I don't think I can.
Drop your knee. You low key. Should know.
I didn't know it.
Still can't be easy schedule.
Oh, yeah.
Studying.
Actually, no, I'm a little sad. I'm just like, fine now. I'm a little sick.
Dude, lucky it's chill though, because you know the chapters are all like 30 per, like 30 slides per last time. So that's last like 40, 50 per. Look at this, look at the other one, bro. And there's like multiple. Oh, for that. Yeah. This one. I was like, dude, I think one of them's devious though. Okay, it's like a 89-page slide deck. Yeah.
Yeah.
Like start stuff.
This is just something.
Just don't do it.
It's like I was reading the text.
What is it?
Yeah.
6:30?
I thought it was.
No, it's at like 1 p.m.
Yeah.
Lucky that's extra time. No, it's not. Oh, yours? Or this one? This class is at 8. Where do you see it on work day? On the syllabus sheet, the one that said 8 to, what he said. Are you took them off for your other class? Wait, check the syllabus for your.
Okay, yeah. So then it's gonna be.
You just said like 11:30 or something.
Well, that goes back to that whole point. Chapter.
Damn, is it the same thing? No. Oh, that's one day before, yeah.
Operation.
Bro, if it was the same day, I'd actually just end myself, bro.
对，是合法单位但是
This class like later. Honestly, it's not different. It's honestly pretty easy. Well, there's so many tax, like, I feel like by the end,
That's
like,
the
you'll
whole
have
point.
like no
At
tax.
what point, now you have the tree.
There's 3 years. Yeah.
The tree's been
Individual.
我感觉你在哪都觉得
I think I have to. Next. Not.
So.
Wait, what do you think? That's in the machine learning.
你要不就跟他说个啥你
Oh, yeah. They said it's closed note file. Like, you do it on your iPad. So it's open note. Yeah. My friend's like, dude, they changed the format, bro. You gotta use your iPad. So it's cheat or cheat. I guess you have to. Wait, but you're ripping these two? FSA and 3620. I heard FSA is mad chill, bro. I have to do that. Dude, my first half of the semester is going to max. It's because I have a half A course. I'm taking topics in qualifying for financial. Actually sounds pretty good. Boom, 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 boom. 11:30 to 5:30. Like before it, bro? Yes. Holy yeah. It's actually schedule of pain, bro. You're not ripping carbon? No, I am. So Monday I have like 1 class. That's half A, right? Yeah. So you're gonna. No, I'm taking a half A class at the same time. I'll just say if you did take a. Dude, I'm taking some data analysis for investments. Bro, look at this easy on class. Topics are religious studies.
What the fireman does.
So you're not taking the ones with the D. Oh, disabilities and resources? No. I was thinking about it, but I'm gonna let him have his own special class. Actually? Alright, fine, if you take it, I'll take it. Alright.
Yes. But since it's a disregarded entity, it's treated as an extension of the branch. The whole thing is the branch taxable? So I'm sure you're gonna argue it's not contractual. But that's where most people who have something going in the United States would think it's not sufficiently contractual. And I think you'll find most advisors would tell you that doesn't trip an audit. That doesn't mean all it does is protect you. If you have this, I at least want to be taxed on a net basis, not. Yes. Yes, they would do that. They would have you explain that.
把我的2个项目全部摊开了。
你已经准备好了？你买票了吗？
没有啊，
你没买票，你急啥？我都买完票了。
猴急的，你说的。不是我在预算，就是要留多少箱子，要买多少东西。
你这办材料，你去哪儿？
That's awesome. So you're gonna have great advice. No doubt about it.
我去万子只买鞋，我没有跳绳。